Today we're talking about the 3 investment-oriented sessions we have planned for the CCA meeting in October. When you think about it, everything an actuary does relates to the time value of money, putting a value on a future financial transaction in today's dollars. This is particularly true for pension actuaries, where the time period gap between recognizing and funding for a future commitment and actually paying it is so long. In other words, there are lots of years you expect to earn return on your funding dollars before those commitments are going to be paid out. Our planning group views our role as providing pension-oriented actuaries with insights about capital markets, investments, and future returns that will help them in this value-setting exercise by raising their comfort level in setting and/or evaluating return expectations. We usually come at this objective in 3 distinct ways. We have one session focused directly on return expectations, another on more hands-on issues related to pension fund investing, and the third, a more theoretically oriented session to help actuaries in essentially thinking outside the box. The first session is titled Yo-Yoing Return Expectations. With interest rates and pricing valuations being jerked up and down in recent years, it's helpful to consider how capital market models deal with those major parameter changes. To some extent, if return expectations go up every time markets go down, and they generally do, when looking over the longer term, it's almost as though the market drop never happened. But is it really that simple? We'll explore that. The second session, Pension Investing Emerging Issues, will review a broad range of more hands-on investment policy topics. Some tactical issues related to managing LDI programs, considerations related to risk transfer programs, and the rationales behind the increased use of illiquid alternative types of assets. We'll also take a look at the issues related to ESG type programs, which have recently become pretty controversial. If you view your role as a fiduciary one, is it appropriate to consider any other objective beyond just maximizing return? And if not, how do you rationalize the incorporation of ESG type considerations? Lastly, in our third session, for long-term investing, bonds or stocks, we'll take a refreshed look at the old financial economics debate and consider whether the assertion that many economists have made that only fixed income investments are appropriate for retirement funding is still holding up. To a great extent, this argument relies on a presumption that equity-related risks increase rather than decrease across time. So we'll be taking a good hard look at that. And if we have come to believe that that isn't true, maybe because markets are cyclical and to some extent mean reverting, which frankly sometimes just seems like common sense to anyone who's observing market behavior across time, then if markets are indeed mean reverting, where are we left with regard to the stock versus bond decision for pension funds? So that's our lineup of 3 investment track sessions for the meeting in October. I hope you will consider attending one or more of these sessions, and then I'll see you in October.